For many, mortgage refinancing is a great option, helping to lower the interest rate on their mortgage. But you should know that it's not quite as much of a deal as you might have thought. That's because you're going to have to invest time and money to get started. You should only jump on this if you can justify expending both. When you buy a house, you're expending a whole lot of work, and refinancing is going to be quite similar. You're going to want to take a look at each of these 8 questions that are going to help you through the process. That's how you're going to be prepared for what comes next. On this video, we're going to review the most important questions you should ask before refinancing your mortgage. First, you should always know, why are you refinancing? There are a number of different reasons that you could be trying to refinance. After all, if you refinance, you might just be able to consolidate your debt. This works if you have a lot of high-interest debts. Cash out some extra money. If you need to pay for something, you could use the cash. Decrease the term on your loan. If you lower from a 30-year to a 15-year. Lock in a rate. If your mortgage is adjustable and you want to make sure you won't pay higher interest later. Decrease your payment. If you want to get a lower rate. The key is to know what you're looking for before you go to see the lender. Your credit score is what's going to get you the interest rate that you're going to get. If you have even 100 points difference in your score, it could dramatically change how much you're paying for your mortgage, especially over 30 years. It's all going to depend on how much you take out, of course, but FICO says that you could end up spending thousands of dollars more in interest. If you had a better score the first time around when you applied for a mortgage, you may want to hold off a little while and try to improve your credit score before you attempt to refinance. After all, your credit score reflects your history, and as you continue to do good things with credit, it's going to keep improving. Just make sure you know that if you're getting a mortgage, they're probably going to pull from all of the bureaus rather than just 1 or 2. Before you go through the process of applying for a refinance, you should also take a look at your loan-to-value ratio. If you owe more than 80% of the value of your house, you will likely struggle to get refinancing. That means high LTV is going to get you denied. For some mortgage lenders, however, you can make a single payment when you apply. That will counter some of the effects of a high LTV. It's also a way to help them approve your application and works sort of like a down payment when you first purchase. Another question to ask yourself is whether your interest rate will get better. This is generally the most important factor, and what it means is should you have at least a 1% decrease in interest rate from your current mortgage to the possible new one. If you don't, you may not want to bother about it. Of course, that doesn't mean that you should always jump at that 1% drop. It depends on how much you currently owe. If you change 1% of $100,000, it's not going to mean as much as 1% on $1 million. On the other hand, some people see benefits even if they're not going to get an interest rate decrease or even if they're going to get an interest rate increase. That's because of variable rate mortgages. For those who have a variable rate mortgage, it might be worth an increase right now to ensure your rate can't go up again. It's also possible that you might want the cash that a refinance can get you and that you're willing to pay more over time. Associated fees is another factor you should keep in mind. Remember, this is going to be a type of investment for you. You want to look at it from a point of view of how much your return on investment is going to be. Make sure you get a breakdown of all of the fees, an estimate before you jump in, and that you're comparing these between at least 3 different lenders. You could end up with closing fees of up to 4% of your mortgage balance, which means that $250,000 mortgage could cost you $10,000. Not to mention, you're going to have to fill out a whole lot of paperwork, and it's going to take up a lot of time, several months in most cases. When you add up all the fees, you could be spending thousands of dollars, and while that may be able to be absorbed into the loan you're taking out, it means you're going to be paying more over time. It's also going to increase your mortgage payment, which may make it less desirable. So make sure you know all the costs before you sign. When refinancing, it's necessary to understand what is the break-even point. Take a closer look at how much you're going to be paying to follow through this process and how much it's going to save you to find out your break-even. You're looking for the point in time where the benefits are going to outweigh your costs. The way you find that is by dividing the costs of the refinance with the amount that your monthly payment has gone down. If you reduce your payment by $500 and you have to pay $5,000 to get it done, it means your break-even is 10 months down the road. For those who plan to move soon, there might not be much of a point to go through this process. When you make a payment on your mortgage, you're building equity. The more equity you have, the better it is for you. And if you have at least 20% equity, then you're in a good spot to start the process of refinancing. For those who haven't had the house long or who didn't make a large down payment, it's possible that you don't have much for equity. If you have a loan such as an FHA Streamline Refinance, VA-IRRL, or HARP, you may not have to worry about equity to get a refinance. Another important question is how long until you move again. If you're going to start seeing benefits within a short period and you're planning to stay in the same home for at least that long, you might be able to reduce the amount of money that you have to pay over time. That's going to help you in the future. For those who plan to move soon, it might not be a good idea because you don't have a lot of equity and you're not getting a whole lot of adjustment to your balance, especially the more frequently you refinance. Remember, you want to get the benefits, and when you move frequently and refinance, you could end up with more costs than you save. Pay close attention to the other debts that you have right now and whether it's really going to be a good idea to pay them off with a mortgage refinance. You may be able to consolidate debts into your new mortgage based on the equity in your home. After all, you're going to be spending a lot less in interest on your mortgage than any other debt you have. If you're going to be paying a lot of money for something in particular in a short time frame, you may also want to look at using the money you get from your refinance to cover the expense. On the bottom line, when you refinance, you may be able to save thousands of dollars in interest, and you may even be able to decrease the time frame for your mortgage. But you need to pay attention when you do. Look at the costs and what your plans are to make sure you're making a smart decision on your home. That's it for now. On our website, you can find more posts, as well as calculators and other financial tools. Considering refinance of your mortgage? We would love to know your thoughts, so feel free to share them with us in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel to get the best financial videos for free.